Hello, everyone, and welcome to our next episode of this series called Towards Life 3.0, with the subtitle being Human in the Age of Artificial Intelligence. My name is Mathias Risse, and I'm the director of the Carr Center for Human Rights Policy here at the Harvard Kennedy School. This title of our series, so the Life 3.0 part of that series, we take from Max Tegmark's fascinating book, Life 3.0. Sorry, I actually got my wires crossed here. So the book is called Life 3.0, Being Human in the Age of Artificial Intelligence. And our series, of course, is called Towards Life 3.0, Ethics and Technology in the 21st Century. That is the name of the series, and the title for that series we are taking from Max Tegmark's wonderful book. The goal of our series is to explore the ethical and human rights related issues that arise in the course of technological innovation, the kind of innovation that is happening all around us, and that might eventually take us to a full-fledged Life 3.0, which would be a phase of life populated by entities that get to design both their culture, which is their software, so to speak, and their bodies, their hardware. So they get to design both of those as opposed to the preceding types of life that in Life 2.0 only get to design their software, their culture, but not their hardware. And Life 1.0, which only gets to design neither of these, right? It just genetically is what it is and doesn't change, doesn't develop itself. We do not know if that kind of life will ever emerge or when, but we also don't want to start thinking about its ethical dimensions only once it is clear that it will indeed emerge. And in any event, there are plenty of such challenges, ethical and human rights related challenges all around us already that occur as part of technological innovation. And among those challenges is the one that concerns us today, namely how the accelerating use of digital technologies changes the way our banking system handles debt. And allow me just to say a few words on the background of this rather fascinating and also rather vexing question. So throughout history, societies have debated the morality of debt. Allowing people to go into debt enables them to do things now that otherwise they could not afford to do, at least not now. And it thus enables them to build a future in systematic and deliberate ways by way of using resources that need to be provided from some outside source. But then at the same time, so that's the great advantage of lending and borrowing practices, to enable people to do such things. But at the same time, practices of borrowing and lending also create particular patterns of power relations and might quickly turn efforts at creating one's future into great misfortunes if either things don't work out. So obviously there can be bad luck of sorts, or if those power relations are actually abused. Accordingly, religions like Christianity and especially Islam traditionally have actually looked askance at many lending and borrowing practices, classifying them all as usury, the kind of activity that a virtuous person should just not engage in. At the same time, then growth-driven modern societies have long depended on a well-functioning banking sector that makes a large share of society's resources available to those who wish to invest in the future. And that, of course, does so for a price, for a hefty fee coming from those who are provided with these resources in this future-directed way. Now, millions of families have managed to build intergenerational wealth in this way, also and especially in the United States, by participating in these lending practices. But this is also very much a history replete with unfairness and prejudices. One of the great American novels, Upton Sinclair's The Jungle, is, among other things, a story of predatory lending that takes place in the immigrant community in Chicago around 1900. And of course, African Americans and other groups were long systematically excluded from the more beneficial lending practices that the US government supported and made available to white people in particular. Now, recent banking scandals, of course, make clear that this is not a matter of the past, but that the long shadow of these past developments is still very much present in the banking sector. And in recent years, then the rise of AI and data-driven lending has added new dimensions to this really millennia-old debate about the morality of debt. And so in this talk now, the new morality of debt is a neat continuation of such debates that have been going on for a very long time. And the speaker for today, Nikita Aggarwal, about whom I'm going to say just a few sentences in a moment, will examine this new morality of debt in the age of datafied lending and consider how financial regulation should actually adapt to this new technological reality. Now, just a couple of things on Nikita. Nikita Aggarwal is a technology, I'm proud to say, is a technology and human rights fellow at the Carr Center. She used to be an attorney in the legal department of the International Monetary Fund, where she advised on financial sector law reform in the Euro area and also worked extensively on initiatives to reform the legal and policy frameworks for sovereign debt restructuring. Before that, she was a practicing attorney specializing in EU financial regulation and sovereign debt restructuring. And based on all that experience, she re-entered then academia and is now a PhD candidate at the Faculty of Law at the University of Oxford, and already a very distinguished contributor to this field in which we are moving here today. So Nikita's research explores the legal and ethical challenges due to emerging data-driven technologies. And she has written widely on topics ranging from the gig economy to AI crime and the demise of big tech platforms. She's also fostering research in the field of intercultural digital ethics, which will be the focus of a fellowship at the Carr Center, and in fact is now leading up to a conference that will be happening in just a couple of weeks here and hosted by an internet web conference hosted here at the Carr Center. We'll turn it over to Nikita now, who will speak for about 20 minutes, 25 minutes. And after that, we're going to have some Q&A. I'll be asking some questions, but you in the audience are very much encouraged to put your questions in the YouTube chat function. In fact, we are very eager to get your questions. We'll be monitoring that, and so in that way, we hope to integrate you into this discussion also. But now, without further ado, let me turn it over to Nikita.
Thank you so much, Matthias, for that very kind introduction, and for also highlighting some of the themes that I'm going to be building on in my remarks today. I should also say that I'm delighted to be at the Carr Center this year as a fellow, and to have the opportunity to work with you and Sushma on these very interesting questions. So my talk today, as Matthias has already prepared you for, is titled "The New Morality of Debt," and I want to proceed in three parts. So to begin with, I want to provide some background, some context. What is debt? What kinds of debt are we talking about right now? And whose morality are we interested in? I then want to pick up on some of the points and themes that Matthias introduced about the morality of debt. So to go back a little bit historically and think about the original moral questions that debt has raised, and sort of what are the main narratives around the morality of debt that lead us up to the present day. And then that will be the focus of the third part, the new morality of debt. And that's to say, how has digitization and automation changed the narrative of the morality of debt? So to begin with some background, some context. What exactly is debt? The term debt can be used to mean many things. It's a very broad term. We speak of debts of gratitude that we owe to people who have helped us. We speak of debts to society, our debts to humanity, the universe, our ancestors, our parents. These are kind of social debts or existential debts. Of course, they are incredibly important and raise many very interesting moral questions. However, they aren't the focus of my remarks today. Instead, I'm going to be focusing on a much more technical sense of the term debt, and that specifically is financial debt, namely a promise or an obligation, typically a contractual obligation, to repay a sum of money. Now, financial debt is the lifeblood of the modern economy. Countries, companies, consumers all borrow, they all incur debt in order to finance consumption. And at each of these levels, public and private debt, there are moral questions. Many of you will be familiar and following the ongoing discussions about the US debt ceiling. And even there, which concerns public government debt, there are some moral dimensions to that debate. I'm going to be focusing on private debt and specifically private consumer debt. And so that's borrowing by individuals, households, and typically lending by private financial institutions. And then the final context setting point to make is that morality is, of course, culturally specific. I don't proclaim to talk about any universal morality of debt, but I will be focusing on the jurisdictions that I'm most familiar with, that is the US and the UK. So with those background points in mind, I want to begin by going back some years and thinking about what are the main narratives around the morality of debt that we have seen in the past decades and centuries. And I think there are sort of really two main narratives that we saw. So sort of through antiquity and up until the early 20th century, there are really two main narratives. The first is the idea that debt is, in essence, debt is sort of the earliest form of obligation. And paying back debt is really the essence of morality, the idea that one ought to repay one's debts. At the same time, and this is something that Mathias raised in the introductory remarks, there has for many years, many centuries, been a strong view that debt is per se inherently immoral. And we see indications of this perception of debt in many contexts. So we see it in religion, whether that's through prohibitions on usury, so it's lending, but particularly lending at a high interest rate, the prohibition on charging interest in Sharia law. We see it in literature. So think of, for example, the portrayal of moneylenders, say Shylock in Shakespeare's Merchant of Venice, portrayed as sort of greedy character, somewhat immoral, and someone who needs to be converted. And we see it in language. We see, for example, words like in German, the German for debt, Schuld, or a word for debt, which is synonymous with guilt and sin. And so in all of these examples, what it's pointing to is this moral view of debt as being something that's wrong, inherently wrong. It's also encapsulated in the Puritan ethos of thrift, that saving is morally superior. So we have phrases like a penny saved is a penny earned, or a nickel saved is a nickel made. And the idea that one should not take on debt because it supports hedonism, it supports an immoral lifestyle, or that it's wrong to live beyond one's means. And so, and sort of accompanying that is a sort of view that there is a risk of exploitation through a debtor-creditor relationship because of the imbalance of power, and indeed more powerful parties have through history exploited the weaker, and so you have these kind of competing narratives sort of going back. The idea that you must repay debts that are incurred, but that debt in itself is something to be avoided. So going from that picture, fast forwarding slightly to the post Second World War era, and so starting triggered and fueled in no small part by the Second Industrial Revolution. What we see in this period is a growth of the consumer society, of the credit society, and particularly since the 1970s with rising inflation, wage stagnation, deindustrialization, credit becomes an increasingly essential part of life, of the economy, and that the average person needs to take on debt in order to smooth consumption, in order to sort of supplement income, and it sort of becomes a sort of social safety net for people. It becomes a sort of form of privatized welfare. So what we start to see is this new conception, a new kind of image of debt as being something necessary, as being essential, and not something that is inherently immoral, as in the Puritan ethos that I talked about earlier, but something that is actually critical and necessary for living a good life, or for maintaining a basic standard of living. And so it becomes essential, and through also the marketing efforts of companies, credit card companies in particular, that are trying to expand their product and sell their product, you also have this new narrative that not only is debt essential, but it's also empowering, that access to credit can give you access to a lifestyle that you would not otherwise have been able to afford, that it's also democratizing, because it's no longer only the wealthy or the asset rich who can afford certain luxuries, but everyone can. So there's a new narrative of debt as good, as debt as something that is desirable. And the sort of, I would say that the sort of site of the morality of debt then shifts away from the inherent right or wrong of debt itself to questions of distributional fairness. So debt is essential, but some people are getting more, or credit is essential, but some people have more or better access to credit than others. And that becomes the sort of main site of morality, if you like, from the 70s onwards. And particularly focused on concerns about discrimination, where especially African American and other minorities are being denied credit, often due to outright direct discrimination. And this is unfair because they need access to credit. And so we see practices such as redlining that led up to the passages in this country of statutes like the Fair Credit Reporting Act and the Equal Credit Opportunities Act, which were designed to stamp out discrimination in lending. So it becomes a question of distributional fairness, ensuring that people have access to credit. And that's a sort of new site of morality, of the morality of debt. And related to that is not just that about access to credit, but also the cost of credit, right? So the fact that typically the poor or poorer consumers will pay more for credit, and that subsidizes credit, the low-cost credit of the rich, because lenders typically make money from overdraft fees, or from people who maintain a credit balance, and so that in itself is a sort of question of distributional fairness, that this is an inherently regressive arrangement. And so that's kind of what I've described so far are the prior narratives of the morality of debt. And that brings us to the present day. And so, over the last 50 years, and so starting in the late 60s, early 70s, there's been this digital transformation of financial markets. So it's not an entirely novel phenomenon, and it's been in motion for several decades. Banking, finance has gone from being essentially paper-based. Finance has been was a bank-dominated industry to a much more digital, automated, and decentralized one. And this digital transformation, which today we call fintech, has really accelerated in the last 20 years, particularly as society has become more datafied, and with advances in data analytic techniques, particularly in machine learning, and with applications, internet applications like social media, we have sort of entered into a new era of this digital transformation, a new era of fintech. And so today, we can take out loans, we can make payments, we can invest, pretty much all through the convenience of an app on our mobile phone. And a particularly salient development in this current era of fintech is the use of new forms of data, new sources of data, new types of data, and data-driven analytic techniques, including, for example, machine learning and deep learning, to assess consumer creditworthiness for credit scoring, and therefore to price credit. And this is a phenomenon that is often, or a trend that's often referred to as alternative credit scoring or algorithmic credit scoring. So whereas traditionally credit scoring has relied primarily or largely on one's credit history, so how we handle or have handled debt in the past, increasingly credit scoring models and lenders are taking into account all sorts of new sources of data, enabled by the fact that everything we do throws up data in this society that we live in. Those forms of data can offer more insights, and offer insights particularly on the creditworthiness of consumers who may not have much credit history for various reasons and have historically been excluded from accessing credit at a fair rate or from mainstream credit markets as a result. And so what sorts of alternative data are we talking about? So this trend has ebbed and flowed, and the sort of use of different types of data has changed in the last 5 to 10 years. But at different points, we've seen many different types of data being used, everything from Netflix, your payments on online subscription platforms, whether that's Netflix or Spotify. So these are sort of alternative forms of financial data, not strictly credit data, to entirely non-financial data, like your social media activity. How many things do you like? Which groups do you join on Facebook or on TikTok? How long do you spend watching a particular video? And then data collected, for example, from your browsing activity on a lender's website. So how long do you spend reading the terms and conditions of the lender's product? How do you complete the online application form? Are there many spelling mistakes? These are all sorts of new signals that are being taken into account, more so by startup fintech lenders rather than mainstream lenders, although this is becoming an increasingly mainstream trend. Certainly in the UK, one of the major credit reference agencies, Experian, recently launched a product that would basically allow consumers to share their Netflix payment history with credit reference agencies, and so to build your credit report. I believe here Fannie Mae recently announced that they would start to take into account rental payments to contribute towards creditworthiness assessment. So it's a global trend, one that we're seeing in the US and UK in particular, and it's a growing one. But what does this mean for the morality of that? Well, I think what it does is make the morality of that more nuanced. It builds on, it sort of deepens, makes more complex the existing narratives that I've already set out, and it does so in really two ways. So on the one hand, this trend towards alternative credit scoring can enhance consumers' autonomy. It can be empowering because it provides access to credit for consumers who had previously been marginalized, locked out of mainstream credit markets, or been offered much more expensive credit as a result of a lack of credit history or the sort of traditional forms of credit data. And so to the extent that credit is essential and credit is a necessity, then surely this is sort of enhancing the morality of that. And it's supporting consumers, it's autonomy enhancing. On the other hand, however, clearly this trend erodes consumers' privacy, right? So it involves some very intimate details about how we consume and our day-to-day lives being used to inform financial and particularly credit decisions about us. And the fact that increasingly our identities are being shaped by all of this data, and we don't have much of an ability to control how that data is being used. So how do lenders interpret the data, and what do they know about us? Oftentimes they might know more about a consumer than the consumer knows about themselves, is arguably autonomy diminishing, and that we're losing control of our identity, losing control over how we are perceived. So you end up with you still have these competing narratives, and these sort of two ways in which datafication, digitization in consumer credit markets can be both autonomy enhancing as well as autonomy diminishing. Also, from the point of view of distributional fairness, clearly by improving access to credit for marginalized community, you stand to enhance fairness in consumer credit markets in society. At the same time, however, there are concerns, and that this could contribute to some level of unfairness in two ways. First, that there is scope for the use of sometimes what are referred to as black box algorithms or more opaque forms of machine learning that could have discrimination that is hard to detect, or have discriminatory outcomes or impacts that are harder to detect. Or, for example, if models that are used by lenders are not well trained and not well tested, and this is a product of, this would only be a result of a regulatory system that hasn't fully caught up, then if it's based on, for example, data that are biased, then it could just perpetuate those biases and in that way sort of amplify unfairness as opposed to resolving it. There is a more fundamental concern, which is that even though you might be able to price more fairly the credit of a consumer who was previously being charged more or denied credit, i.e. a genuinely low risk consumer who was being treated as high risk simply out of a lack of eligible data. You also have the converse or the opposite problem, which is that certain consumers today are benefiting from a sort of a lower cost of credit because their risks are hidden due to the unavailability of information. So if the sort of turn to alternative credit scoring means a higher cost of credit for those consumers, you have greater variation or variance within group and intergroup. And then back to this concern, the fundamental concern, which is that if credit is essential, then more expensive credit for a consumer is in autonomy diminishing. So I've set out in the last, I think, 20 minutes or so, many different perspectives on the morality of debt, and hopefully conveyed how there are multiple narratives, competing narratives of the morality of debt. The challenge for regulators is really to find a way to balance these benefits and the harms and these competing narratives, where credit is at once essential, but also a potential source of harm to consumers and to society. The question is where do we find the right balance? How do we strike that balance? I think one way to approach this is to say that we want to take a long-term perspective, and that in the long term, what kind of society do we want to live in? Is it a society in which all of our behavior is monitored and analyzed and used to inform clearly very consequential financial decisions about us? And of course, this comment is not limited to financial markets, but sort of broader logic of surveillance capitalism that characterizes the current era. Or do we want to sort of put some guardrails around this? Do we want to impose some hard limits? Not least because it's not simply an individual problem, that while certain consumers might benefit from the use of their data to, price their credit and give them access to credit, that same data can also reveal information about other consumers who might be harmed by it. So there are these negative externalities to data processing, which advocate for a more collective solution. And certainly from the initial regulatory efforts that we've seen, there is a suggestion that governments and regulatory agencies are erring on taking a more cautious approach. So to give just a few examples before I conclude, the EU is currently in the process of revising the Consumer Credit Directive, which is sort of the main law governing consumer credit markets, unsecured consumer credit markets in the EU and previously the UK. It very specifically, at least in the early draft, suggests that lenders would not be able to use data other than data that directly relates to a consumer's financial creditworthiness. So it's sort of pointing towards limiting the uses of data and is therefore sort of pro-privacy standpoint to only data that is directly relevant to their financial standing. The proposed EU AI Act, again, this is a proposal and a draft, also takes a position that's a more strict one on credit scoring. So it would designate, first of all, it would designate the type of credit scoring that I've been describing as inherently high risk and subject to more safeguards. So these are just indications of early developments in the regulatory space. This doesn't stop it from being a hard problem to solve, but one that deserves attention because, as I hope I've conveyed, there's some very tricky and complex moral and ethical questions that the new datafied lending raises. Thank you.
Thank you, Nikita, very much. And thank you also in the audience who have already put questions in. Please keep it up. I'm going to turn to your questions in a moment. Allow me just to start off with a few questions of my own. So Nikita, I think this is absolutely fascinating field, especially also in efforts to go beyond the traditional credit score in obviously meaningful and morally sensible ways. Because the credit score certainly has wields a lot of power over people's lives. Yeah? So what you can do, especially in American society, depends very much on what kind of credit score you have, as certainly all those of us know who at some point joined this country, came to this country and didn't have a credit score and realized how regularly that meant you would be running into this wall or that wall. And of course, the credit score, it's also a very thinly defined construction. It reflects particular kinds of behavior, also particular kind of regularity in financial behavior. So it is not just some kind of neutral account keeping of financial responsibility. It's a very narrow understanding of what financial responsibility in the past has been. But then, of course, the question is, how exactly can we do better? And you pointed that out. How can we do better without creating new problems? And one thing that I'd be curious to hear is what concrete proposals are on the table. What is there? Is there a list of data proposals, ideas about what should be integrated in addition to the particular pattern of financial behavior that credit scores reflect? So you mentioned, Netflix data. So obviously one can think of all sorts of stuff that in the age of big data can be found to correlate with certain behaviors. But are there concrete proposals to flesh this out some more? What we would be getting into?
Do you mean from regulators or from the private sector?
Anything. So anything that's kind of concretely on this. So somebody says we don't want to use the credit score, the traditional credit score anymore. Here's what instead we'd like to do, and it might actually be interesting to hear whether there's a particular private sector initiative that says we think we'd be much better off using these bits of information, or a regulator says the society would be much better off if we used different kinds of information. What's the scope of debate there?
Yeah, so in terms of the market, there's been a lot of innovation in the last 10 years, in particular around alternative data, not just in relation to credit scoring, but we'll focus on that. And so from a market perspective, there's basically an appetite for trying to use as many types of data as possible, and particularly if you're a lender that's trying to reach higher risk populations, and populations that typically have had lower, less or thinner credit histories, or thinner credit files, then basically this is something that they are very keen to do, because alternative data allows them to lend or to price the credit of those consumers. So there's been a huge push. So an early kind of example in this area, or sort of pioneer or a company that was very vocal in alternative credit scoring is called Zest Finance. You may have heard of them. And many others followed in the US and in the UK. I think there's been an interesting kind of development on the market side, which is that sort of Zest Finance and Zest AI and other similar companies were most prominent or were getting most visibility and coverage in the media sort of in the early 2010s. So, now almost 10 years ago. But then more recently, we started to see a couple of developments. One, that there was more awareness about the moral concerns, about the privacy concerns. And this is part of a broader awareness, right, around Facebook and how much these companies know about us and surveillance capitalism and all of that. So there's been a shift in sentiment. And so you've seen companies, including Zest Finance, say, okay, well, we're not going to use all types of data because that might be a bit creepy. So we won't use social media data, even though I think many lenders would like to, ideally, because it offers many insights into a person's behavior and their preferences and so on. So not just for lending, but also for advertising and so on. So because of the sort of change in sentiment, because of the new kind of public awareness, there has been a shift. At the same time, we've seen, and I think I mentioned this in my remarks, that we've seen more kind of establishment players, and particularly I'm thinking of credit reference agencies, start to build products that incorporate alternative data. So Experian, at least in the UK, and I believe so here as well, is explicitly taking into account rental payments, now Netflix payments, or at least it offers a product, a credit scoring product to lenders that would do that. So from the market side, and we've seen that kind of shift. On the regulatory side, I think there's nothing massively concrete so far beyond the two proposals that I highlighted. Of course, in a general sense, more privacy regulation should, in theory, mean more limited scope to engage in this kind of practice. If you want to take, for example, the principle of purpose limitation under the GDPR seriously, if you want to take it seriously, then you wouldn't be, I imagine, really permitted to take data from one context, say a dating app, and use it for a credit decision, because that would seem to breach the fundamental principle of purpose limitation. I don't think it's interpreted and applies this strictly. So in practice, that probably does take place. But the more recent proposals around the CCD and the EU AI Act, I do think are taking a much harder line. The CCD, and I don't remember the exact wording, or the proposal does essentially try to limit the scope of data that can be used for creditworthiness decision making, and this might be watered down. Certainly, no EU directive or regulation is adopted in its initial form, and then the same thing for the EU AI Act. It's a proposal, but it would impose much more rigorous data quality and model testing requirements on lenders amongst because alternative credit scoring or use of AI systems of credit scoring is deemed in this text as being inherently high risk.
Okay, thank you for that. So one comparison that suggests itself here is to the Chinese credit scoring system. So the Chinese credit scoring system has come up for a lot of negative commenting in Western countries, because it is basically capturing a surveillance state mentality. It is tracing the technological upgrading, updating of the Chinese Communist Party that a lot of people 10 years ago thought would gradually transform into a more democratic institution in response to the increasing rise of the middle class in China. But instead, something completely different happened, namely the Chinese Communist Party moved fully into the 21st century by using big data and data mining techniques in order to impose this multi-dimensional credit scoring control system on its population. So one way of being worried about the proposals around alternative credit scores could be put as follows. So you could You could draw here on Shoshana Zuboff's fascinating work on surveillance capitalism, right? You could say Shoshana Zuboff has pointed out to us already how what we have done while the Chinese communist system upgraded into the 21st century, we have not upgraded democracy into the 21st century. Instead, we have succumbed to surveillance capitalism, in which all our realities are commodified all the time through this enormous amount of data surveillance. And so one could say, basically, any positive take on alternative credit scoring would be illusionary. It would be something like, we would be trying to convince us that something that overall goes so massively into the wrong direction nonetheless might have some marginal advantages, right? But it's all really dependent fully on the functionality of surveillance capitalism. So that would be a way of capturing this concern. One big concern about such alternative scoring techniques. How would you address that?
Yeah, I think you put it well, Matthias. So I talked about the long-term perspective, right? Which is that, in the long term, what kind of society do we want to live in? And so is it a society in which all of our data and everything that we do can be monitored and analyzed and interpreted and used to make decisions about us, whether that's financial credit decisions or others? Or is it one in which we have some more privacy and also some more control over how our information is used? I think where this becomes, the trade-off is really in, like, how do we decide how to allocate credit, right? So if we're allowing private institutions to engage in risk-based lending and they want to be able to, so are we going to allow private lenders to be able to use data in order to more accurately price credit and to assess consumer creditworthiness? And given that credit is essential, the sort of question is, well, if that enables access to credit for many people and credit is essential, then do we just allow that to happen? And that takes priority. The ability to access credit at a fair price takes priority over concerns about privacy and potential loss of autonomy due to control of our data. Or do you really, what we're really saying, that we need a public solution, that we need to have, because credit is essential, because credit is essential, it shouldn't be subject to this logic of calculation, that actually there should be access to credit by right, if that's not too extreme a position to take, or one that doesn't depend on the need to commodify all of our data, because it's so essential in the world that we live in. Of course, in practice, it's a very complicated question of the sort of how do you subsidize that access to credit and who pays for it. But I do think there are some very fundamental questions to be asked about how we allocate credit, given that it's essential, and whether it needs to rely on data, or it should just be available as a matter of right.
Okay, thank you for that. I will ask one more question and then turn to audience questions. So one fascinating connecting point between your work and that of previous Carr Center fellows, in fact, in this very program on human rights and technology, is to the work of a mother-daughter team whom we had in the program, Teresa Hodge and her daughter, Lauren Leonard. And it's a fascinating story. So also with some rather sad components. So Teresa Hodge got hung up in the American criminal justice system and spent about 7 years in prison because of that. And when she left prison, she experienced what millions and millions of Americans experience, that having been in prison, having a criminal record, 70 million Americans have a criminal record of sorts. Makes it incredibly hard to re-enter the labor market. And so since then, she and her daughter, Lauren Leonard, have devoted themselves to making it easier for people who are leaving prison to join the labor force, an overwhelming task for the United States, given that 1 in 4 people who is anywhere in a global prison is in an American prison, right? We have an enormous incarceration rate. And one thing they've been working on is actually also the development of an alternative credit score. And the idea there is that re-entry into the labor market is basically guided by these 2 kinds of data, right? The credit score and your criminal record. And there's a correlation between them, right? If you have a criminal record, then various other things happen in your life, and you would not have a stellar credit record, right? So this could be one area. My earlier concerns, in terms of parallels to the Chinese system notwithstanding, this could be one area. So the re-entry of previous, people who spend time in prison, their re-entry to the labor market, where an alternative system conveying better information could really help. Has that intersected with your work at all, this domain?
I mean, I think it's part of the same conversation, right? Which is that credit gives you access to many other opportunities that are essential for leading a good life, or for well-being, and so that includes access to labor, access to a decent wage, amongst other things. And so I think it's back to the same kind of paradox that we've been discussing all along, which is that the alternatives credit score offers to empower many people, and it offers many advantages in many ways. The question is, how much are we willing to give up for it? And I think we need to answer that question by taking a long-term perspective, because in the long term, it might not be worth the cost of our privacy and sort of autonomy as a result of that. And also, as we were talking about earlier, it sort of raises the question of whether access to credit, access to labor should depend. Why is it that we have to trade our privacy in order to have access to these essential goods?
Let me turn to a few audience questions now. So one member of our audience is asking the following: is the concept of financial debt necessary for democracy? Can a debt-free society be democratic? Can a debt-free society be democratic? What do you make of that? That's quite
a question. I might need some time to meditate on it. Can a debt-free society be democratic? I don't see why not. I think the question might be more one of whether a debtor society is necessarily undemocratic. I mean, I might have to punt on that and take it away for some homework.
Yeah, you could think. I mean, there is a kind of Republican traditional democratic thinking that advocates for simplicity, right? A kind of a simplistic outlook on life and a meeting among democratic equals as part of a one could think of a Jeffersonian ideal of an agrarian society, but then where in a way partly the financial and administrative structures of society are minimized, so that certain abuses of power do not even become possible, right? But then one would wonder how doable that still is in the 21st century. Yeah, let's turn to another question. So this is taking us into a slightly different direction. How have cryptocurrency and NFTs complicated the morality? So it's complicated enough, Nikita, but here's a complication question, a further complication question. NFTs, non-fungible tokens, and cryptocurrencies, how do they enter this debate?
Yeah, it's interesting. Actually, I was just finishing up writing a chapter on the future of financial privacy. And I think cryptocurrencies come into the discussion in one specific way, which is that just to add to the complications or the nuances, that there is both a sort of privacy enhancing and privacy diminishing aspect of this move to crypto and also CBDCs, as sort of central bank digital currencies. The origins of the Bitcoin were to decentralize money, to decentralize power, to enable trustless, so-called trustless transactions. And one of the main sort of selling points was this idea that you had this pseudonymity, that you wouldn't know necessarily who transactions are. And so it's supposed to be sort of empowering and autonomy enhancing, because it really protects the privacy of the transactor. This was sort of the original vision of it, and the reality, of course, is that not the way in which most cryptocurrencies and CBDCs are going to be designed is not going to be entirely. It's not going to be entirely anonymous. It's not going to be entirely uncontrolled, and more importantly, control over the sort of blockchain, over these currencies, is increasingly concentrated in few institutions, and whether that's through cryptocurrency wallets or through central banks who will be managing these cryptocurrencies. So sort of raising questions about whether what we gain in terms of sort of having a pseudonymous ledger of transactions, we lose through the concentration of power and information in fewer hands.
Thank you for that. Then there is another question that was posed there by another fellow in our program, Alex Voss. Alex is asking, so as I understand this question, so if we are building a more complicated credit scoring system, so different sources of information, he's asking to what extent the existing inequities, the long shadow of the past, will make it possible for the more privileged people in the contemporary scenario to actually manipulate that. So if I'm a powerful player, privileged player, then I have ways, and maybe not I personally, but there will be, once we have something like that, there's going to be consultants, right? So people will try to make themselves useful. Just like we have money advisors now, right? So there will be a new type of money advisor, and they will say, here is how you can, manipulate your score by using all sorts of software in order to prevent to prevent certain bits of information from entering, negative information from entering into that score, right? So how worried should we be?
Yeah, this is an old debate about gaming concerns, questions about gaming the system, and the use of technologies technologies to obfuscate, to hide. So what we would often say is that there's a kind of there is a distributional concern here, because the more educated and the more wealthy will typically be more will be more technologically savvy and equipped. So might have better access to privacy preserving technologies, so they could pay for it. So they could pay for, I believe, there are people offering privacy consulting, or they offer to clean up your online profile, so that before you go for a job interview, people will now clean up your online profiles and make sure that the prospective employer can't find anything that they wouldn't like online. And so in the same way, to answer the question, these services cost, and clearly the more wealthy you are, the more access you have to them. But not just the fact that you can pay for them, you're typically likely to be more technologically literate, digitally literate, and be aware of these these services, or even more simple solutions like ad blockers or cookie blockers or whatever it is. And so I definitely think there is a distributional aspect to this, which is that the ability to game the system using these tools is greater. That ability is greater the more advantage or more wealth you have. And to add to that as well, that answers your question, I think.
Yeah. Thank you. So it seems whatever the system is, those who are well positioned in it, due to as a reflection of past records, will always find ways to advance their position further, and there will always be people who will be consultants, right, on that to help them with it. Yeah. So since we have a few minutes, maybe as by way of coming to a concluding point also. So I know it's, and I mentioned this in my introduction also, you have you have broad intercultural interests also in the use of digital technologies, and that's an important part of your work, how digital technologies are used in a comparative perspective in different cultural contexts in different countries. Can you maybe tell us a little bit how do these two bits of work intersect? Your work on, your thinking around alternative credit scores and the new morality of debt, and your interest in the intercultural dimensions of digital technology use.
Yeah, this is a fascinating area, and one that I am starting to research more. So I can only really offer sort of speculations as to, or sort of working hypotheses. But I do think that what I've described so far is a much more let's say West-centric view of the morality of debt, and not to overly generalize, but I'm inclined to believe that the concerns about privacy are not so strong in certain other countries, and at the same time, the value to individuals of accessing credit through things like alternative credit scores are greater in lower income countries, right? Like, so where you have a large unbanked population and much lower access to formal credit, the sort of marginal benefit is a lot greater from these products. And so I think that makes the sort of trade-off, the balancing act, very different. And I think it might be useful to also mention, of course, I've been talking mostly about developments in the US and UK, but a lot of the innovation and actually some of the pioneering innovation in this space was in lower income countries. So, work on using mobile phone network data in Kenya, for example, and other similar platforms in India. They were some of the early movers in this space. So I think in large part because there is a bigger market that could benefit from this. And so it's an interesting question, one that I hope to be able to think about a bit more deeply.
Okay, and I think with that, we are more or less out of time. Thank you, Nikita, for walking us through these fascinating considerations. Obviously, availability, access to credit is a hugely important question. A few years ago, we had another visitor here, not specifically at the Carr Center, but at the university here, the young German philosopher and economist named Marco Meyer, who was working on a project that has since appeared also as a book. He was working on, is there a right to credit? Specifically, is there a human right to credit? And he argued that there is, and that might sound a little bit strange at first. Why would there be, why would that be so important in the first place, so that there would be a human right? But of course, it is important because it means access to it means having a right of access to a whole machinery that allows you to build a future. A machinery to which a lot of other people do have access. And your discussion, Nikita, has just highlighted again just how incredibly important the financial dimensions of our lives are, how important it is that we stay abreast of these developments, and also just to make sure that they're not just working out for a few people in society, but really are of more broader benefit. So we are very grateful to you, Nikita. Any concluding sentence you'd like to say?
No, just to say thanks so much for the invitation. And I feel it's very meta talking to you through a screen, even though you're not so far away physically.
Yeah. Thank you, Nikita. Thank you to our audience. And I hope you and the audience will join us again.